All right. Well, today's topic is on flexible budgeting, and we have a lot to cover tonight, but I will take some time to look back at some of the master budget drills that were noted in the homework from last week as well. Okay? So let's turn in our workbooks to page... Let's go to workbook page 401. 401. And I'm going to share my screen with you. Okay. So today we're talking about flexible budgeting, and I just want to go over with you some of the budgetary control concepts and terminology. And actually, before I do that, I just want to kind of preface where I am in the class with what we're talking about. So I guess over the past couple weeks, we've been talking about different aspects of budgeting. Last week, we looked at the budget for an entire company. So we looked at, we did several master budgets. We combined several budgets together, and we called that the master budget. But that was looking at the company as a whole. And today what I want to do is look at individual departments within the company and create a budget for them. But then I want to go one step further and actually compare the budgeted amounts that we have for each department, compare that to their actual operating results. And then we will draw some conclusions from those operating results compared with their budget. So here we go. We're going to page 401, and I'm going to share my screen with you. All right, so budgetary control concepts and terminology is what we have here. So let's just walk through some of this terminology. The first one you should be familiar with, management by exception. This says only investigate significant differences between budgeted and actual results. Okay, and the key here is significant. That means the big differences. So let's write this down. As well as I want to add something here. We investigate the significant favorable and unfavorable results. So it doesn't have to be a negative result for us to investigate. It can also be favorable. And I'll talk a little bit about why we want to look at favorable results or investigate favorable results as well. Okay? Any questions on this? All right, let's look at the next one here. Our next bit of terminology is responsibility accounting. And this involves accumulating and reporting revenues and costs.
Excuse me, Mr. Arabia. Yeah, I couldn't write, the management by exception. Could you just give, I don't know.
Oh, okay, I'm sorry.
Could they get a little bit of time to write down the concept?
Sure, go ahead. Finish writing up.
Thank you.
Yeah, let me know if I'm moving too fast. I have time to pause here. Any other questions on management by exception? So responsibility accounting. This involves accumulating and reporting revenues and costs on the basis of the manager who has authority to make day-to-day decisions about the items. So write this down. I'll talk a little bit about it next. And I wrote here, the manager's performance is evaluated on matters under his or her control. Responsibility accounting. And this is really what we're going to be focused on doing tonight. We're definitely going to be accumulating a lot of costs, but we'll also accumulate some revenues. And I'm going to be walking you through a scenario with a particular manager, and we're going to just kind of take a look and see how this responsibility accounting really plays out. Any questions there? How about decentralization? This says that the control of operations is delegated to many managers. And this is clearly seen when the companies have many subsidiaries, vice presidents, maybe they have several locations or several departments and or managers. So I'll give you a couple of examples here after you write this down. Okay, so an example of some decentralized business operations, I guess I'll just use the Walt Disney Company as an example. Clearly, that's a huge company with several subsidiaries. They have not only Disneyland that we're all kind of familiar with and heard about, but they also own ESPN, ABC, the television broadcasting company, and they have a lot. There's actually a Disney Studios. That's just another subsidiary. But each of those subsidiaries has assigned to it, I'm just going to say for lack of a better word, a vice president. And that vice president at each of those subsidiaries has people working underneath them. So they might have different department heads and managers just operating under them. But this is what I really mean by decentralization. The control of operating the Walt Disney Company is actually delegated to many managers. Does anyone know offhand who is the chief executive officer of the Walt Disney Company right now? Anybody know?
I don't remember his name, but isn't it that guy who was the head of the Walt Disney Parks?
I need a name.
It's not Eisner anymore, and it's not
Not
Iger.
Michael Eisner. Who was that other name?
It's not Iger anymore. Iger resigned like 2 months ago.
Yeah. So who's in charge? Okay. So we know it was Iger up until a little while ago.
Yeah.
We haven't really gotten to know the new person yet, right? In fact, you could throw out a name and I wouldn't know because I just don't know now that Iger's gone. I think the person's done a couple press conferences, but I really haven't paid too much.
I think his name was Bob Chippick. Yeah.
Bob Chippick? Okay, I'll give you that. We'll go with that. So it's one of those things you wouldn't expect Bob to run the entire operation on his own. He's delegated authority to others, to other vice presidents who in turn have delegated their authority to other managers at different locations and whatnot. So this is decentralization. Another business operation that I'm familiar with is, I'm sure you've all heard of Warren Buffett, okay? So his company that he owns a great deal of, a large portion of and manages, is called Berkshire Hathaway. And this particular company, he has delegated his authority to different business divisions and different subsidiaries, but he actually has different presidents of those different subsidiaries. So he might be the chief executive officer, but he in no way keeps track of the day-to-day operations of all the individual subsidiaries. I mean, that company owns NetJets, which is a jet leasing service. It owns a train, actual passenger and cargo train company. It owns Geico Insurance, and actually several others that you are familiar with and you just never knew they owned. But he's actually delegated or put in charge different presidents and vice presidents of those different subsidiaries, and he probably couldn't tell you who's doing what beyond the presidents of the different companies. He's just very hands-off. So that's decentralization. Let's look at number 4 here, our fourth bit of terminology, controllable costs. So this is a cost over which a manager has control. And if you're in top management, all the costs are controllable by top management. But as you move down the chain of command, as it were, fewer costs are controllable by the lower level managers. So these are controllable costs. Oops. I don't want to move off that slide too soon. Does that make sense to everyone? Anybody have any questions on that? Look at number 5 there, non-controllable costs. This is just the opposite. Costs incurred indirectly and allocated to a responsibility level. So here we mean that managers really don't have control over these particular costs, which is why we call them non-controllable. And so the two key words here I want you to pay attention to are indirectly. That's telling you that the manager really doesn't have control over this particular type of cost. And the word allocated. I did mention this in a previous lesson when we were talking about should we eliminate a business segment, an unprofitable business segment. And we needed to pay attention to allocated costs. And then finally, we have controllable margin. I need to give you a formula here for this because I want you to be able to calculate the controllable margin. Here we take the contribution margin, which we've learned about already, contribution margin, which is our sales minus our variable costs. And then we're going to subtract the controllable fixed costs. This equals the controllable margin. So contribution margin minus the controllable fixed costs equals the controllable margin. And this is the best measure of a manager's performance in controlling revenues and costs. Okay, so when we look at evaluating managers, we want to look at really the controllable items that they can, the items that they can control, and not the ones that they can't control. Okay. All right. What questions do you have for any of this terminology here on page 401? So we'll keep referring back to this terminology throughout the discussion today. So just be aware of those little buzzwords. They may come up here. All right. Look at page 402. Page 402. We want to take a look at a budget report. And we're going to use an example, company, the peanut butter company. Okay? And I'm going to walk you through a scenario here with the peanut butter company. Page 402. So it says here that Manny is the production department manager for peanut butter company. He's a little upset because the vice president of the company has called him into the office to discuss his department's poor performance in sticking to the budget. Okay, so I don't know if this has happened to anybody. When your boss calls you into the office and something's wrong, you're on the hot seat. So that's what's going on with Manny here. So what we want to do is take a look at this budget report and complete it just to find out why Manny is in trouble, okay, because he's the manager of this department. Now, just look at the budget report for me. In this budget report, the header is, the name of the company, the name of the report, budget report, for which department. It's the production department, And in this case, it's for the month that ends July 31st. Now, a budget report compares, now look at these columns now. We've got a budget column and an actual column. So here's the budget column. Let me put my pointer on. Here's the budget column, and here's the actual column. So a budget report compares the budget that was created to the actual operating results. So this column here, the actual column, these are the actual operating results from Manny's department. And you can see here that on the far left here, we've got variable costs and we've got fixed costs down below. Now, I want you to notice though, this department is called the production department, which means this department is producing something for the company. Manny is not responsible for generating any sales revenue. And we'll talk about why that might be a problem later. But the production department manager, Manny in this case, he should not have to be responsible for any sort of revenue or sales revenue. So in this report, we're only going to hold him accountable for things that he has control over, variable costs and then fixed costs. What I would like for you to do is complete this difference column here in the far right. Essentially, you want to compare the budget column to the actual column, find the difference in those two numbers, and the absolute value difference would be fine. You don't need any negative numbers here. Just what is the difference between the variable costs and the fixed costs for each of these line items, okay? I'll give you a moment with that. Please do that. Absolute value numbers is perfect. You don't have to write any negative numbers. Okay. Now, this exercise should have been fairly straightforward, so let's just review here. Your difference column should have the following numbers in the variable cost area, and all of the fixed costs should be 0. Okay. Any questions on just those numbers? Okay. Now, it's not enough to just say what the differences are. We need to actually report, are these differences favorable or unfavorable? Okay. And the way we do that in managerial accounting, or at least in this class anyway, we write the letter F or the letter U next to the dollar amount difference that we've calculated. So we're going to be writing a lot of F and U's in this class as well as next class as well. So we call these variances. And so we need to write the letter F next to something if it's a favorable difference, and the letter U next to it if it's an unfavorable difference. Okay, so here we go. In the variable cost area, it seems like all of the actual dollar amounts were higher than the budgeted dollar amounts. So all of these differences then have to be unfavorable. So you should write the letter U next to all of the variable cost dollar amounts. But we see in the fixed cost area, all of the differences are zero. And a zero difference is a good thing. So you can write the letter F next to all of the fixed cost amounts. And I'll do that now. Now, before we move on, I do want to indicate that there will be differences between your fixed cost budgeted amounts and your fixed cost actual amounts in the real world, and sometimes even in a classroom setting. So don't just think because it's a fixed cost that your actual and your budgeted amounts are always going to be the same. That's not the case. You could have a fixed cost that's actually rent expense, and you didn't plan on having the landlord increase the rent on the business. So that would represent an actual difference from the budgeted amount of your fixed costs. But now I want to focus you here on just these variable cost areas, because this is where all the unfavorable results were. Okay, let's just focus on these major differences here. This is why Manny's in trouble with his boss. I mean, this is why he's been called into the office, because this budget report shows a lot of unfavorable variances. And so we're going to proceed with our storyline here and figure out what actually happened that created these unfavorable differences. So look at page 403 with me, page 403. It says that Manny, while he's in the vice president's office, he's at a loss for words concerning his department's poor performance in managing the costs. Remember, if you are the manager of a production department, your only job is to keep those costs as low as possible. That is your job. So Manny goes on to ask, he says, who in the world came up with this unrealistic budget? And that's a fair question. I mean, we actually need to talk about that. How do we come up with these budgets, and why doesn't the manager know how this budget was come up with? That's a point that we need to emphasize today. So it says the vice president explains that the budget was developed based on the production of 2,500 units of peanut butter. Okay, so the vice president says we calculated based on you making 2,500 units of peanut butter that you would have those budgeted dollar amounts that we saw here on page 402. That's how this budget was created. So let's start to break things down a bit. Bottom or middle of page 403. The question is, what is the per unit variable cost of the budget? Class, I want you to calculate the per unit variable costs for this budget. Meaning, look at the budget column. Look at the budget column on page 402 for the variable costs. For example, this $10,000 here of direct materials. We need to find the per unit amount of that. So we're going to divide this $10,000 by 2,500 units. So please fill out page 403. Give me all of the per unit amounts on those variable costs for this budgeted amount. All right, so your per unit amounts that you should have come up with are as follows. Okay, so just double check your numbers, make sure you matched my numbers. And let me know if you have any questions here, please. Okay, all right. I assume you're all good then. Okay. So next, look at page 403. We're going to continue with our storyline here. Page 403.
Professor, quick question. And the budget amount that's listed here, like the 10,000, 15,000, where did they come up with that amount?
The company has put the budget together in their planning stage of that particular year. So management has to create that budget. So kind of like we created a budget, a master budget last week, that's where this budget gets created.
Got it.
Okay. Anything else? Other questions there?
Just one last question. If it's a new company and you don't have previous years to put a budget together, how do the companies put a budget together if it's like a startup business?
A startup business needs to really do a lot of planning before they get started. So one of the things that a startup business should have done before they actually get started is to create a business plan. And within the business plan, a budget is created as extensively as they need. But if you can't think it through before you get started, you should not get started.
Noted.
So that's how that works. Yeah, that's how that works. So creating a business plan, very important. Okay, let's look at page 404 now. And this really brings in today's topic of flexible budgeting. On page 402, that budget report, I just want you to focus on the budget column. That is called a static budget, meaning a budget that has been prepared assuming one level of activity. And that activity level on page 402, that budget was assumed to be 2,500 units, or actually producing 2,500 units of peanut butter. So now on page 404, we want to go ahead and create today's topic, a flexible budget. And a flexible budget is several static budgets combined at different activity levels. So on page 404, it asks us to prepare a flexible budget, not a budget report, but a flexible budget for 2,500 to 2,800 units of peanut butter in this case, using increments of 100 units. So I've already got the header filled out for you. In that first column, just to help you get started, we want to put a budget together assuming 2,500 units of peanut butter. Now this is actually pretty simple because on page 402, that budget has already been prepared. So I'm simply going to copy over the 2,500 unit budget from page 402, and this is what the numbers are going to be. So you can go ahead and write this down for now. Okay, so even though this budget was given to us, you could have recreated it using the workbook page 403 material, the variable cost that we had, and then just pulled over the fixed costs. Now it's your turn to create a budget for 2,600 units, 2,700 units, and 2,800 units. And I'm going to help you with that. Let's start with the 2,600 units. What I've done here is just kind of written in next to the words variable cost. I just wrote in all the per unit dollar amounts to help me. But we're going to multiply all of these per unit dollar amounts for the second column times 2,600 units. So write in 2,600 units on that top line, and then I want you on your own to calculate 2,600 units times $4. That'll give you direct materials. 2,600 units times $6. 2,600 units times $13, so forth and so on for these variable costs. The fixed costs are just going to be the same as in the 2,500 unit column. Those don't change with the activity level. I'll give you some time with that. When you're done with your 2,600 unit column, just kind of look up at me. That'll tell me to continue with the other columns. Okay, so in these other, in the 2,600 unit column, here's what I came up with. You tell me if you got this, or you let me know if you got something different. So for direct material, the dollar amount should be $10,400. Direct labor, $15,600. Indirect materials, $33,800. Indirect labor, $23,400. Utilities came to $5,200. And maintenance came to $13,000, with our total variable cost being $101,400. And then again, the fixed cost should just match what we had in the 2,500 unit column. So any questions on how I came up with any of those dollar amounts? So if you can do that column, I'm assuming you can do the other columns. So I'm just going to go ahead and put up, I'm going to put up the remaining columns here. So this is our 2,600 unit and 2,700 unit columns. So you can just write these down. I'm not trying to kill you with a lot of math tonight. Oops, sorry. Okay, I think that's the two you need. Okay, 2,700 and 2,800 units. Okay, I see that some of you are finishing up the writing of this, so I'll just talk a little bit about it. So again, the flexible budget report, a flexible budget is a combination of several static budgets, just at different activity levels. So here we've got, in this flexible budget, we see 2,500 units of activity, 2,600, 2,700, 2,800. And so companies will begin to put these together to help better evaluate different managers' performances for their different departments. But now this is not a budget report. This is just a budget, a flexible budget only. The difference between a flexible budget and a flexible budget report is that the report brings in the actual operating results. So let's continue on in our scenario here. Look at page 405. It says, Manny informs the vice president that his department was able to find efficiencies in the production department and was able to produce 2,700 units of peanut butter. Manny further requests that he and his department be evaluated based on their actual production of 2,700 units. So if you'll recall, on page 402, Manny's budget, or the budget report that Manny was being held responsible for, was based on only making 2,500 units of peanut butter. And so he's saying, hey, listen, boss, we got, we did things so effectively and efficiently in our department, we actually made 2,700 units of peanut butter. So of course our costs are going to be higher than looking at 2,500 units of production. So my question to you all is, if you were Manny, which of the columns on page 404 do you want to be evaluated against? Is it the 2,500 unit column, 26, 27, or 2,800 unit column? Which would you prefer?
2,700.
Yeah, makes sense, right? 2,700 units would be the best thing to evaluate Manny by. So now you need to prepare a flexible budget report for this production department. And actually, you're not going to have to do any more math. Let's look at this together now. Where are you going to find the budget numbers for this particular flexible budget report? Where are you going to find that?
On the
Under
actual?
2,700.
All right, you're going to look at page 404 under the flexible budget column for 2,700 units. That's where you're going to find these budgeted dollar amounts. Where are you going to find the actual dollar amounts, class?
On page 402 on the first budget list.
Right. Look at page 402 in the original budget report. You've got actual operating results for Manny's department. So that's where you'll find those numbers. So fill out these first two columns. And then if you want, you can go ahead and fill out the difference column as well. I'll give you some time with that. Ask me questions if you have them.
Question here.
Yes.
Is direct materials for budget, is that 10,800?
It should be on the budget side.
Yes.
Yeah, well, I mean, look at page 404 under your 2,700 unit column. Whatever your direct materials is there. I don't have it in front of me, so
Okay. Okay.
yeah, I
Thank you.
can't tell you offhand.
Thank you.
10,800.
Since we're just copying over the budget and the actual dollar amounts, I'll go ahead and write those in. And then all you need to do is figure out the difference column. Remember, in the difference column, it's not so much about writing minuses when you need to write a minus, but it's always about putting, is the difference favorable or unfavorable?
Sorry, I had a question.
Yes.
Is any difference in the variable cost considered unfavorable period, like all the way around?
Oh, no. If what you're actually looking for here is to compare, since you're only talking about costs, anytime the variable cost is lower than the budgeted cost, that's a favorable result. If the budgeted cost is lower than the actual cost, it's an unfavorable result because we're talking about costs here. So the lower, the better.
Okay, got it. Thank you.
Okay. So let's take a look at that difference column. So in the difference column, here's what I came up with. All favorable results. All favorable results. Okay. Questions on this, please? Okay. So what I want to do now is point out some things here. Number one, well, let's see. I guess what we can say is here, once we look at this budget report, now Manny is to be congratulated, I guess, or maybe he's going to ask for a bonus or something, I don't know. But now that we see that we're comparing him to the same activity level, we're comparing his actual results to a similar activity level of a budget, all of his variable cost results are favorable, as well as the fixed cost results. They're still favorable. So he's probably going to be congratulated here. But what I want to draw your attention to here is, I want to talk about this management by exception bit of terminology that we talked about earlier today. One of the questions that Manny needs to be asked about by the vice president is, well, you know, that was pretty significant in how you were able to produce more peanut butter, having found some efficiencies. Now, it's a good thing that he did that, but management needs to know, how was that achieved? What exactly went on there that allowed Manny to make more peanut butter than expected? Because if he was able to find efficiencies in his department, once the upper level managers can find out what those efficiencies were, they may be able to replicate them throughout the rest of the company. Okay, so this is something that we really need to look further into. All right, so management by exception says, if the differences here in this in the difference column, if these variances or differences are significant, we need to investigate them. So their management would have to decide, are any of these differences very significant that require further investigation? But I'd say that we definitely want to investigate the difference in the amount of peanut butter that was actually produced, the number of units, just to find out if we can replicate those same efficiencies elsewhere. Okay? So that's very important. Talk to me.
The original budget was at 6490 and this is at 1310. So yeah, there's a big difference there for sure, 5,000.
Well, yeah. And it's the direct result of the number of units.
Correct.
Yeah. Other
Question.
comments? Yes.
Will the total variable costs and the total manufacturing costs always equal the same, whether it's favorable or unfavorable?
No, they will not. The only reason our total variable costs equal the total manufacturing costs in the difference column is simply because there was not any differences in the fixed cost area. And that's usually not the case. Fixed costs do have different actual results than the budgeted amounts. They absolutely do.
Okay. Thank you.
Mm-hmm. Other questions, comments? Wonderful, wonderful. And then turn over to workbook page 410, 410. Turn to page 410. And I'd like for you to answer those two questions on page 410. Answer the two questions on page 410. So we're doing page 410, answering the two questions on page 410. All right, let's take a look at page 410. Carlos, what'd you get for number 1?
150,000.
And that's correct. Yeah, $150,000. Does anyone have questions on how we got number 1?
Yes.
All right,
What page?
page 410. So number 1 asks us, if this company actually produces 10,000 units, what is the flexible budget amount of fixed costs? So in this particular example, in a flexible budget, your fixed costs would be the same regardless of activity level. So under 12,000 units, the fixed cost was $150,000. And likewise, under 10,000 units, the fixed cost would also be $150,000. Someone else, tell me what you got for number 2. Anybody?
Morgan,
Yes.
how do you compute, I understand 150,000, how do you compute the column, shape column and rows here to find 150,000? Can we do that?
How do you compute 150,000?
I understand 150,000, but how do we perform columns and rows here like the one we did in previous?
Okay, we'll get to that next. Somebody share with me your answer for number 2.
$166,666.67.
Margaret, is that your answer as well?
Yes.
Okay, so 2 people agree with each other. All right, anybody have a different number?
Yeah, I rounded the cost per unit to 1667 and got $166,700.
Okay,
I got $100 cheaper. I got 166,600.
yeah. So
Looks like we're
depending
all
on where
close to
you
the
round,
same answer, but
yeah, depending on where you round, you would get it. But now this particular one, number 2, represents everything we just did in creating a flexible budget on workbook page 404. Everything we just did, you need to be able to use those skills in order to create it. So I'm going to walk you through step by step just how we get the answer to number 2. So I'm going to share my screen with you. And we're going to look at an Excel spreadsheet here as I do this. All right. And so again, this is page 410. I'm answering question number 2. So in the original scenario, we had variable costs. Pardon me for typing in all caps. I don't want to do that. The variable costs were given to us as $200,000. So that was assuming that 12,000 units were produced. Okay. So now we want to calculate the variable costs at 10,000 units. So the first thing we need to do is to take this $200,000 and break it down to a per unit amount by dividing it by 12,000 units. And we get a little over $16.67. I'm going to, now rounding may occur depending on where you decide to round. I'm going to go out to 2 decimal places, okay, and say that this equals $16.67 per unit. So this is the per unit amount, okay? So now I'm going to multiply this per unit amount times 10,000 units. I'm going to multiply the $16.67 times 10,000 units, and I get now remember, I'm using 16.67 as my per unit amount, okay? And I get, I'll go ahead and make this into a dollar amount. I get $166,700. So depending on how many decimals you put in your per unit amount, you might get a slightly different number, okay? So
That's a much easier way.
Oh, okay.
So the way I got was really bad. It was like I divided 12,000 to get what percent of 200,000 that was, and then times 10,000 by 1.96 to try to get my answer.
Yeah. So that is a different way to do it, but based on what we covered in creating a flexible budget, this is actually the steps we went through. We created this per unit amount that I'm showing you here. We created this per unit amount on workbook page 403. And then we went on to prepare the flexible budget for Manny's Peanut Butter Company on page 404, you know, looking at the 10,000 unit level of activity and eventually arriving at some dollar amount for variable costs, okay? So questions on this, please.
Yeah, the way that you presented is very logical, you know, how do you go to, you know, the price per unit. But I did it, you know, dividing 10,000, divide to 12,000, and then multiply by for $200,000, and you get the numbers right away to that way. I know yours makes sense to explain everybody, you know, it's easy.
Okay.
You know,
So now these are just little quick drills, but if you're at work and you actually have to prepare a flexible budget, you know, you're gonna have to take the time to do all the steps. Okay.
Absolutely.
Yeah. Okay. Very good. Very good. Other questions or comments, please. All right. Okay, go to workbook page 413. I want you to answer the question on page 413. This is flexible budget drill number 4. Yes, we're on page 413. We're doing flexible budget drill number 4. Okay, you should be done by now. So, in this particular one, Carlos, what was your answer you wanted to offer us?
40,000.
All right. Does anyone have a different answer?
No.
All right, I heard a no. Does anyone need me to go over how we get 40,000?
Is it 360,000?
Well,
Is it net income that we're asking about?
we're asking about net income, expected net income. All right, let's go over this. Now, this, I'm going to share my screen with you again here and walk. Okay, so here we're presented with some information based on the production of 20,000 units of a particular product. Okay, and we're given some information here. It says the flexible budget is actually for 20,000 units, so we're going to have some sales revenue.
40,000, never mind.
I'm still going to go through it. We have some sales revenue. We've got some variable costs. And we've got some fixed costs. So our sales revenue is given to us as 400,000. And our variable cost is 160,000. I'm just going to write this in as a negative number. And we've got our fixed costs. We don't want to forget the fixed costs. The fixed costs are 200,000. I'll write that in as a negative number. So that gives us net income of, is that 40,000 there? I believe so. Net income here is $40,000. Okay. So that one, I guess, is pretty easy because the units that the budget was given to us for was matched the units of the information in the production. Okay, so that one was pretty straightforward. Now, just so you know, if I asked you about, well, what is it for 30,000 units, you would, I'll just do that separately over to the side here. If I wanted to know about 30,000 units, what that budget would look like or what that expected net income would be, I would first find the per unit amount of the variable aspects of this. So the revenue would be this $400,000 divided by 20,000 units. That'll give me a per unit amount of $20. And then I could also find the per unit amount for the variable costs. So that's going to be $160,000 divided by 20,000 units, giving me $8 per unit. Now I don't need to find the per unit amount for the fixed costs. I don't need that because I know that the fixed costs are still going to be $200,000 in my 30,000 units column, okay? So then I could say the sales revenue at 30,000 units should be $20 times 30,000. Got that right? And the variable cost would be $8 per unit times 30,000. I'll make that negative.
Are the fixed costs always the same?
The fixed costs when you're creating a budget are the same, unless there's something that causes the fixed cost to change at higher activity levels. Okay, so the net income is going to be
$160.
Yep, 160,000. Okay, so that's just an example of how we could convert this to a different unit amount. But you always need to make sure you pick up the per unit aspect of sales revenue and variable costs. That's very important. Okay, the fixed costs per unit really don't matter, so you don't want to do that. All right. Any questions on that? Yes.
How do you, what is the role of 20,000 units in the first part, the 20,000 units? Why the question give this was 20,000 units?
Why did it give it to us?
Yeah, what's the role of 20,000 units? Because just you add them for net income and don't use that number, 20,000 units here.
Oh no, we do use 20,000 units. It's indicating to us that the production amount that gave us the sales revenue and the variable costs was 20,000 units. So we are using it in this example. I'll hide this information here for a moment. So this 20,000 units that was given to us, it indicates that the sales revenue and the variable costs, I'll highlight that in a slightly different color, it indicates that these two green costs here, revenue and costs, were created based on 20,000 units. So with that knowledge, we would be able to use it to create more activity level columns. So you're going to get some practice with this when you begin to do other budget drills. So I just wanted to point that out in this particular example. Any other questions on anything else we've covered today? Questions on anything we've covered today so far?
So basically for our next test, we're going to have to keep in mind the last test. Is that correct?
Well, the last test. Okay, so I'll talk more about what's on your next test at the towards the end of this class. Yeah, I'll cover what's on there. But you definitely need to know that, you know, we're picking up where we left off from actually with the last exam. So, you know, a lot of the stuff on the last exam won't be covered on this next exam, but there may be some finer points that do carry over.
But we'll have to use it in order to get the correct answer, like we just did?
Oh, yeah. So there's some things you cannot forget. Like, I'm not testing you on any sort of break-even analysis, but we did learn about the income statement, the CVP income statement. We're going to continue to use the CVP income statement throughout the rest of the semester. I did have one bit of terminology today on page 401, the controllable margin on page 401, item number 6. I gave you a formula there that assumes you understand the CVP income statement.
Correct, I saw that.
Yeah, so some things you can't forget, but we will be focusing primarily on things that followed that exam. But I'll talk about that.
Professor Morgan?
Yes.
Number 2 in page 410, what's the answer to that?
410.
Number 2.
I believe we calculated the answer as, let me go back to it.
166,700.
Yeah, $166,700.
So for number one is same, and number 1 and 2, same page. 4, 1.
Okay, number 1, the answer was $150,000, and number 2 was $166,700. Let's turn to workbook page. Let's look at workbook page 409, like the household cleaner. And I will share my screen with you. Page 409. And of course, I got to get there myself. So let me roll through all this. Okay. Responsibility centers is what I want to talk about. Every business can be broken down into responsibility centers. And you need to figure out, where do you want to work? Okay, where do you want to work? So I'm going to describe 3 different responsibility centers, and then I'm going to ask you the question of where or which responsibility center do you want to work in? Or better yet, which responsibility center do you want to be the manager of? Okay, I think that's pretty important. Which one do you want to be the manager of? Or have some high level authority in, okay? So the first responsibility center I have here is called a cost center, a cost center. Here's my definition of a cost center. This is a responsibility center that incurs costs but does not directly generate revenue. This is page 409. A responsibility center that incurs costs but does not directly generate revenue. So this is like the production department that Manny was in, that he was the manager of. He was not responsible for it generating revenue or selling anything. It was all about keeping control over the costs of the department. Okay? So just think, with a cost center, you don't have to sell anything to anyone, and all you need to do is keep the cost as low as possible. Okay? All right, so that's the cost center. The next center is a profit center. Here, this responsibility center incurs costs just like the cost center, but it also is responsible for generating revenue. So you need to ask yourself, do you want to be the manager of this type of responsibility center? Are you comfortable being responsible for generating sales revenue for the company as well as controlling the costs of the company? Okay. Finally, we have number 3 here, an investment center. So in this responsibility center, this area controls costs. They incur costs, but they also generate revenue, just like the profit center. But they have the added responsibility of investing a lot of money on major projects. So they have control over the investment funds of the company, or they're given control over certain investment funds of the company. So ask yourself, do you want to have this much responsibility? So in the chat area, please type in which one of these centers do you want to be the manager of? You got to pick one. Got to pick one, because there's only 3 in life. There's only these 3 in life. Someone said the investment center for the higher salary. I'm not mad at you. Not mad at you at all.
Professor Morgan,
Yes.
the investment center is all about the government job?
No.
No?
I never said anything about a government job. But you can put a government job in any of these categories.
I don't know, because it's like investment.
Yeah. So I'm going to describe these in a little more detail for you after I get everyone to say which center they want to work in.
Okay.
Because there's some upsides and downsides to these things.
Thanks.
I need everyone to pick a center. But everybody, if you want to have a job in any way or a career, you're either going to work in a cost center, a profit center, or an investment center. And I want you all to rise to the level of management and be responsible for things. So let's see here. So let me describe some of these to you, okay? In the cost center, you're only responsible for keeping the costs low. You never have to interact with the people that the company sells to. And a lot of you might feel more comfortable there. And this could include the accounting department. So, I mean, a lot of people, hey, I want to work in the accounting department, put me in my cubicle, I never want to talk to anybody, I don't want to sell anything. That's a cost center, okay? So I can just say this might be the most comfortable place for you based on your own personality. You have to decide that for yourself. Now, the downside to a cost center is that when times get tough for the company, you're going to be the first one fired, okay? You're going to be the first one fired. Anytime a company undergoes a dramatic shift in their business operations, the first thing they look to do is cut costs. So if you're not bringing in money for the company, we're going to fire you. You're going to be at least the first considered to be fired. This is page 409. We're still on page 409. And but in the cost center, because all you do is incur costs for the company, even if you are keeping them low, we're going to fire you first if we need to increase our net income for the company. So just think about it. If the business merges with another company, how many accounting departments do we really need? So we're going to fire people in the cost center. I mean, how many vice presidents over the accounting department do we really need? So this is something for you to consider if you want to work in a cost center. But just remember, you heard it from me first, okay? All right. Now, the profit center, yeah, you're going to have to get out there and start selling stuff. You're responsible for selling things to the public. So even at Disneyland, a good example, or a good example at Disneyland of a profit center would be when you walk off the It's a Small World ride. I don't know if anybody's ever been on that ride there at Disneyland. It's a Small World. And when you get off that ride, you wind up in a profit center. And it's also known as the It's a Small World store. Okay, you walk right into the store. And so if you're the manager of that little store at Disneyland, you're responsible for managing the costs of, paying employees in terms of making sure you have the proper amount of staff on hand at any given time. But you're also responsible for generating sales. So that means making sure your employees are properly trained and know how to interact with the customers. You might even have to interact with the customers, but you're responsible for that. So that's the profit center, an example at Disneyland. So that's a good thing. When a company or when a business is having financial difficulties, you don't want to get rid of the people that actually bring in revenue for the company. So you want to become good at selling something. And that might be difficult for some of you, but I want to encourage you to get comfortable interacting with customers. It's all about generating sales revenue for a company. When times get tough, you do not fire the people that bring in revenue. Now, if you're horrible at bringing in revenue, we're going to fire you, but you want to you want to actually do that. I see a question here. What's an example for a cost center? The accounting department at Disneyland. The accounting department at Disneyland is a good example of a cost center. All right.
Question here.
Yes.
If you're in the accounting department and you need to upgrade your database or your system that you use, wouldn't you need to talk to other people to tell them, you know, someone what type of upgrade you need or something to do your job?
Oh, absolutely. Yeah, especially if you're in the management role in the accounting department. Absolutely. You've got to interface with other people. But if you're starting out your career, you're not yet the manager, and you just want to work in a cost center and not have anybody mess with you or talk to you or bother you, you might be looking for a cubicle somewhere in the corner. The accounting department, you know, more and more so, not so much, but a lot of people think they can go hide out in a cubicle in the accounting department. But in fact, everybody's got to get out there and talk to other people. So you're going to have to work on interpersonal skills no matter what.
Okay, got it.
Yeah.
Thank you.
Let's look at the investments. Oh, I had a question. Go ahead.
Yes, a profit center is like a salesperson from any company, right?
Well, not necessarily a salesperson, but a person who is responsible for generating sales, but also controlling costs. So the pure salesperson, you know, they just go out and sell as much as they can. Now their manager is responsible for them, is the profit center of it all. You know, so you might just be responsible for generating sales, and your manager just says, hey, go door to door and knock on every door you find, sell these knives, you know, sell the cutlery.
Could you argue that a marketing center or a marketing department would be a profit center?
No, a marketing department is definitely a cost center.
Okay.
Yeah, marketing departments are cost centers. I mean, you're being very creative and things like that, but hey, if we merge, do we really need a bunch of marketing people around? How many do we really need?
Actually,
Talk to me.
marketing is one of the things that promote your business, so you need a lot of those guys.
Oh, no. I don't think so.
You can do a lot with very little.
I don't want to confuse marketing with sales. I don't want to confuse the two, okay? The marketing department might design an advertising campaign that goes on the radio or TV, but that's not generating sales.
Right, but if
It's playing a role.
They can't buy from you.
Yeah, it's playing a role, but it's not actually generating the sales. In fact, you know what? I'll actually give it to you that they are playing a role generating sales. And I think at some point I say that you don't want to spend less money on marketing if times get tough. So actually, I'm going to give that to you. I'm going to give you that one. You don't want to get rid of the marketing department people, but you may outsource it. You may definitely outsource it. Yeah. I've known people that do that. They're operating their business, and then they go off and, you know, they say in order to save money, we're going to cut costs, and so we're going to decrease our marketing budget. And I think that's a horrible first move. I'd look to cut other costs before I cut marketing, because it actually does generate some sales for you. Okay. Now the investment center, this is a biggie. Some of you said you wanted to work in the investment center. Now, again, I want you to rise to the level of management. So let's say you're a management of the investment center. Now, I want you to think of Disneyland as an investment center. You're the manager. You're the vice president of Disneyland. So you're responsible for generating sales revenue. You're also held responsible for controlling costs. But now you've got this extra element that you're responsible over the investment funds. So you need to make decisions like, should we tear down the It's a Small World ride and build, Jurassic Park? You know, should we do that? So that's a long-term decision, but somebody's got to make that decision. Right now, Disneyland just recently opened Star Wars Land. I don't know if anybody's been there, but you know, that's I haven't really seen it for myself, but from what I see on TV and hearing from my daughter, that place is huge. You know, that's her words, not mine. And they tore down other rides just to put in the Star Wars Land ride. Or
I was working there when they did it. When they were discussing what I was working there when they were discussing what departments to get rid of.
Yeah.
They destroyed an entire building that was dedicated to Imagineers, just to a portion of the parking lot, and parts were restored, supplies and things.
Mm-hmm. Yeah, that was a huge decision. So just think, there was somebody at Disneyland responsible for making that decision. And the fun part is that person is going to quit before they actually find out, was that a good decision? That person will quit. When you're in charge of investing money or a lot of money for a company, it might take several years to find out if it was a good decision.
Take the money and run.
Yeah, or spend the money and run, I guess. So I consider this to be I'm going to say it's a presidential decision when it comes to investing money for a company. It's a presidential decision. And I say that being humorous to some extent, but I look at all the presidents or people that we've had as presidents in the United States, certainly since I've been alive. They have all said that they can balance our budget, the national budget, not the national debt, but the national budget.
Easily.
Yeah, well, yeah. In my lifetime, there has only been 1 year by one president where I've actually seen that their annual budget for our nation was actually balanced. Only 1 year. And I am mid-40s now. I look good, thank you. Appreciate that. But yeah, in 40 years, only one president in one of the years that they were president actually that had a balanced budget. And that president was who? Does anybody know?
Barack Obama.
No, it was not Obama. Oh, you're crazy.
Bill Clinton.
It was Bill Clinton.
Absolutely
Bill Clinton. Yes. No, it definitely wasn't Reagan. It was Bill Clinton. Now, I'm not saying the president had any impact on this, but I'm just saying that all presidents, when they're running for office, they all come out and say, I have a 10-year plan of balancing our budget, the annual budget, not the national debt, but the annual budget. They say, I can balance our budget in 10 years. No one says they can do it in 8 years. No one certainly says they can do it in 4 years. But the reason that they say 10 years is because they never have to be around to see it happen. And if you pay attention to, if you just look back when Donald Trump was elected, he had a 10-year plan. If you look at the ex-president Obama, he had a 10-year plan. George Bush had a 10-year plan. Bill Clinton had a 10-year plan. The previous George Bush had a 10-year plan. And Ronald Reagan also had a 10-year plan. And that's when I started paying attention, I think. So I don't really remember what Carter did or anything or what he said. But yeah, so it's very presidential to say, I'm going to invest all this money. It's going to make us a lot of money 10 years from now. And you just basically quit before you get there. So that's how it works. So I kind of like that. All right, very presidential in other words. So do you want to actually be responsible for investing a lot of money for the company? It sounds, for lack of a better word, it sounds very sexy. You can go tell all your friends that, hey, I'm responsible for, let me put it in a little simpler terms for you. Let's say that you're in charge of an entire region for Vaughn's grocery store or Ralph's grocery stores or Stater Brothers. You're in charge of an entire region and you have to decide, should you open up an entirely new store in that geographic region that you're responsible for? That's a huge decision. And I have seen grocery stores there in Costa Mesa actually open and close within 2 years, because whoever made that decision to open up that new grocery store in that area, it just didn't work out. So something to think about. Do you really want that level of responsibility? And based on something I saw someone write in the chat area here, you do get paid a lot more money to make those decisions, and it's not easy, but I say go for it. I say go for it. Just quit before it comes out that you made a horrible decision. Yeah. Question on responsibility centers. What questions do you have?
Yeah, with more responsibility comes more money, of course. That's it.
I did not understand you, Carlos. I'm sorry. Could you say that one more time?
Yeah, with more responsibility, it comes more money. Of course, there is a lot of risk there, you know, but you take the risk.
You would hope that with more responsibility, you get paid more money. You certainly are not thinking about an 8-hour-a-day job. You are not thinking about working 40 hours a week. The more responsibility you have, the more no one tells you how much time to take in working. Just get the job done. Yeah, absolutely.
Which means you never stop working.
And you never stop working. Hopefully you can turn it off and go to sleep at some point. You know, that's a different class where I would teach you how to do that, but I have not mastered that by any stretch of the imagination. So, all right. Let's see here. What else do we have? Okay. So in this area that we've just covered, I want you to do a couple things for practice. I want you to cover, I skipped over workbook page 406 through 408, the Walmart lamp company. That's going to give you a lot of practice putting together a flexible budget. So page 406 through 408, the Walmart lamp company. I want you to do that for homework. That's a little scenario there. And then I want you to do flexible budget drills 2 through 9. Flexible budget drills 2 through 9 on workbook pages 411 through 418. Okay, so that's the homework there for flexible budget drills. All right. Okay, so any questions on flexible budgeting for me? Any questions on anything? Look at page 399. Page 399. Now on page 399, there's a prompt there about personal budgeting, and there's an exercise there. I'm really not interested in you doing the exercise right now, but I really want you to spend some time, do a little bit of internet research if you need to, but I want you to basically develop a personal budget. You yourself need a personal budget to live on. Every person that is wealthy or rich or comfortable financially in life, if you talk to them, they will at some point indicate they have a personal budget for themselves, which leads to the fact that they will not be living beyond their means. They're keeping track of where their money's coming from, and they're also keeping track of where they plan on spending their money, meaning they do the planning before they actually spend it. So I want to encourage you to do a little bit of internet research on how to create a personal budget. There's definitely a lot of information out there. I don't want to steer you in one direction or another. I want you to evaluate it for yourself. But I think it's very important that you yourself take the time to have a personal budget. So that's all I'm going to say on that for now, but I'll talk about it again later, I'm sure.